Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Worried about inflation eating into your returns? Inflation-protected securities, TIPS, are designed to help. These government bonds adjust with inflation, protecting your purchasing power when prices rise. TIPS offer a unique advantage. Their principal increases with inflation, and payouts adjust accordingly. While they aren't risk-free, they provide stability in uncertain economic times. Let's break down how they work and whether they fit your portfolio. What are inflation-protected securities, TIPS? Treasury inflation-protected securities, TIPS, are bonds issued by the U.S. Treasury designed to safeguard investors from inflation. Unlike traditional bonds, TIPS adjust their principal value based on changes in the Consumer Price Index, CPI. When inflation rises, your principal grows. When it falls, the principal adjusts downward, though it never drops below the original amount you invested. These bonds pay interest twice a year at a fixed rate. But here's the twist. Since the principal changes with inflation, your interest payments fluctuate too. TIPS mature in 5, 10, or 30 years, giving you flexibility to match your investment horizon. They're backed by the full faith of the U.S. government, making them one of the safest ways to hedge against inflation. How TIPS protect against inflation? TIPS adjust for inflation using a direct link to the CPI, which measures the average change in prices over time. Here's how it works. Principal adjustments. Every 6 months, the Treasury recalculates the bond's principal based on the latest CPI data. If inflation rises by 2%, your principal increases by 2%. If deflation occurs, the principal decreases, but never below its original value at issuance. Interest payments. The fixed rate, coupon, applies to the adjusted principal, not the original amount. This means your semi-annual payments grow with inflation. For example, a $1,000 TIPS with a 1% rate pays $10 initially. If inflation pushes the principal to $1,050, your next payment becomes $10.50. This built-in adjustment means your returns keep pace with rising costs, ensuring your money doesn't lose real value over time. Key features of TIPS. Maturity periods. TIPS come in 3 standard terms. Shorter term, less sensitivity to interest rate changes. Balances D, stability and inflation protection. Best for long-term investors seeking extended inflation hedging. Interest rates, coupon payments. TIPS pay a fixed interest rate, but because the principal adjusts, the actual dollar amount you receive changes over time. The rate tends to be lower than conventional treasuries since the inflation adjustment adds value. Tax implications. Federal taxes. You owe taxes on both interest payments and inflation-adjusted principal gains each year, even though you don't receive the principal until maturity. State and local taxes. TIPS are exempt, making them tax-efficient for residents in high-tax states. If you want safety and inflation protection, TIPS offer a straightforward solution. Just remember, taxes on phantom income can catch some investors off guard. Benefits of investing in TIPS. TIPS aren't just another bond. They're a strategic tool for investors who want to stay ahead of inflation. Unlike traditional bonds, they offer built-in protection against rising prices while balancing risk in a portfolio. Let's explore why they're a standout choice. Low default risk. TIPS are backed by the U.S. government, making them one of the safest investments available. The Treasury guarantees both the adjusted principal and interest payments, so the risk of losing your initial investment is virtually zero. Even during economic downturns, like the 2008 financial crisis, TIPS held their value while other assets plummeted. Here's why that matters. No credit risk. Unlike corporate bonds, TIPS don't depend on a company's financial health. Protection in turbulence. When markets swing, The government's backing keeps TIPS stable. For investors who prioritize safety, TIPS offer peace of mind without sacrificing inflation protection. Diversification in portfolios. TIPS move differently than stocks and conventional bonds, making them a smart addition to diversify your holdings. When inflation spikes, equities and traditional bonds often struggle, but TIPS thrive. For example, during the high inflation of 2021 to 2022, TIPS outperformed standard treasuries by nearly 5%. Key diversification benefits. Negative correlation with stocks. TIPS often rise when equities fall, cushioning your portfolio. Reduced volatility. Adding TIPS smooths out returns over time, especially in uncertain markets. Think of them as shock absorbers for your investments. By balancing riskier assets, TIPS help you weather economic storms without drastic losses. Real-world performance backs this up. In the 1970s, when inflation hit double digits, investors without inflation protection saw their portfolios crumble. Today, TIPS give you a way to avoid that fate, automatically adjusting to preserve your buying power. No investment is perfect, but for inflation protection and stability, TIPS deliver where others fall short. Risks and drawbacks of TIPS. While TIPS excel at protecting against inflation, they aren't perfect. Like any investment, they come with trade-offs. Understanding these downsides helps you decide if they fit your financial goals, or if adjustments are needed to offset potential pitfalls. That's the basics of what TIPS are and how they work. But there's more to learn. Stay tuned for part 2, where we'll cover how to invest in TIPS and tips for making the most of them. See you soon. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.